The following is an update and technical analysis on natural gas futures based upon the daily interval where we have had the natural gas market well positioned for ample supply. It seems to be normal incoming winter conditions, and thanks to robust U.S. gas production and increased flows to major LNG export plants. And despite all of this, extreme and/or more severe volatile cold snaps could pose a risk to infrastructure in certain U.S. regions. The market is heavily influenced by the potential for a warmer than average winter, possibly lowering heating demand, and the upcoming Thanksgiving holiday historically associated with decreased demand, contributing to the prevailing negative market bearish sentiment within the price action of natural gas. And here we are starting to hone in on what you call a major monumental key inflection point based upon this primary reactionary uptrend line. Call it a full year of price support in this primary channel that has been a beautiful trading op, more so to the upside and additionally to the downside, bouncing off key major tan colored monthly interval price support and resistance levels. And that has been just a trading ground for any technical traders each and every time we've come across the top of this primary trading channel. And the bottom of the primary trading channel has been really a swing trading heaven for technical traders here within a space where we have had a well-defined, clean divergent high with negative and bearish divergences constructed on all technical for momentum indicators, only increasing the odds for a technical induced catalyst breakdown below. Once again, manufacturing the headlines of a less severe forecasted winter, and it has been lights off to the races, undercutting the 50-day moving average and the 50% fibs retracement called 3042 spot price support. Took that level out and has been off to the races, down, big move to the downside. Again, putting in a classic looking head and shoulder looking top where the split of the neckline belongs to the 382 fibs retracement called 2783 price support, coinciding with the primary bottom of this primary trading range and channel, where short sellers want to see a daily solid candle close below that key inflection point, ushering in a well-defined daily red sell signal close, only increasing the odds on a complete overshoot, the bottom of that gap resistance, on a complete backfill of the gap, on a potential backtest and or retest, rechallenge the 200-day moving average at 261 and the 253 big monthly price support level, and that has been heavily defended by long traders and deflected off of short sellers for quite some time, cuts through a ton of series of wicks, but a lot more reaction well infused into the monthly time frame. As for bull traders and or long traders, they need to defend this key inflection point heavily at all cost, infused to step in with a complete style of bids correlated with that 382 fibs and the primary reactionary uptrend line for a prolonged move right back up to the 0 fibs 5% retracement to rechallenge that dual price resistance correlated with the 50-day moving average on a potential rally run to go on to rechallenge the 618 fibs retracement, and then additionally an unchecked and unfilled gap up above. Call it an aggressive risk reward long trade setup move to the upside, whereas you do have that positive divergent low with that positive divergences that were infused in the technical momentum indicators are still intact if and when we go on to reflect off this zero line threshold, where bull traders hold the price before a ton of vultures wait down below, waiting to short the widowmaker commodity.